Hello, and welcome back to Boni's Life. It's great to have you with me today. We're going to tackle a big question, one that's probably on the minds of many of you watching. Are the markets overvalued? It's a question that can feel overwhelming, with so much noise and so many conflicting opinions out there. One day you hear we're in a new era of prosperity, and the next, you're told a crash is just around the corner. So, what's the real story? Well, today we're going to cut through that noise. We'll take a deep intellectual and factual dive into the stock market, the wild world of cryptocurrencies, and the often overlooked commodities market. And as always on this channel, we're not just going to rehash what you hear on the mainstream news. We're going to dig deeper, look at the data the big networks often ignore, and give you a balanced, unbiased perspective so you can make up your own mind. So, grab your coffee, get comfortable, and let's get into it. Let's start with the big one. The stock market. The S&P 500 has been on a tear, and it's easy to get caught up in the excitement. But when we look under the hood, some of the numbers are, to put it mildly, a little scary. One of the most reliable long-term valuation metrics is the Shiller CAPE ratio, which is the cyclically adjusted price-to-earnings ratio. Think of it as a souped-up P/E ratio that smooths out earnings over 10 years to give us a clearer picture. As of late 2025, the CAPE ratio for the S&P 500 is hovering around a staggering 39.42. Now, to put that in perspective, the historical average is about 16 to 18. We are more than double the long-term average. The only other times in history we've seen valuations this high were in 1929, right before the Great Depression, and in 1999, at the peak of the dot-com bubble. And we all know how those stories ended. In 1929, the market crashed by a devastating 83%. In 2000, the dot-com bubble burst, leading to a 49% drop in the S&P 500. More recently, in 2021, when the CAPE ratio hit 38.6, the market saw a 25% correction in 2022. History doesn't repeat itself, but it often rhymes, and right now, the rhyme is a little ominous. So, what does this mean for future returns? Well, the data isn't exactly encouraging. Nobel laureate Robert Shiller, the creator of the CAPE ratio, has warned that with valuations at these levels, we could be looking at average annual returns of just 1.5% over the next decade. That's a far cry from the historical average of around 4.8%. In fact, some models are predicting returns as low as 0.5%. Now, the bulls will tell you that this time is different. They'll point to the incredible advancements in artificial intelligence, the productivity gains we're seeing, and the fact that global capital flows are stronger than ever. They argue that these structural changes justify higher valuations. And they have a point. The world is changing at an incredible pace, and it's possible that the old rules no longer apply in the same way. But here's what the mainstream media often doesn't talk about: the risk of mean reversion. What goes up must come down, or at least come back to a more reasonable level. If the CAPE ratio were to revert to its historical mean, we could be looking at a significant market correction, and it's not just the CAPE ratio that's flashing warning signs. The regular trailing 12-month PE ratio is also at 28.5, well above its historical average of 16.2. The forward PE ratio, which looks at expected earnings, is also elevated at around 23. No matter how you slice it, the market looks expensive. And there's another layer to this that you won't hear about on your nightly news. The legendary investor Michael Burry, the man who famously predicted the 2008 financial crisis, has been warning about the dangers of passive investing. So many people are pouring money into index funds and ETFs, which has created a sort of self-fulfilling prophecy. As more money flows in, the prices of the biggest stocks in the index get pushed higher and higher, regardless of their underlying fundamentals. This has led to a massive concentration of risk in a handful of mega-cap tech stocks, the so-called Magnificent Seven. This concentration makes the entire market more vulnerable to a downturn if just a few of these giants stumble. It's a bubble hiding in plain sight, and it's a risk that very few people are talking about. So, while the party in the stock market is still going strong, it's worth remembering that all parties eventually come to an end. And the longer this one goes on, the worse the hangover could be. Now, let me give you some additional context that might help you understand just how precarious this situation is. When we look at the historical data from 1983 to 2015, we see a very strong inverse correlation between the CAPE ratio and 10-year forward returns. The correlation coefficient, or R-squared value, is 0.78, which is remarkably high in financial markets. What this means in plain English is that when the CAPE ratio is high, future returns tend to be low, and vice versa. This isn't just theory. This is what the data tells us. And right now, with the CAPE at 39.42, the data is screaming that we should expect below average returns for the next decade. Some analysts are even suggesting that we could see negative real returns, meaning that after accounting for inflation, investors could actually lose purchasing power over the next 10 years. That's a sobering thought, especially for those of you who are counting on the stock market to fund your retirement. But let's not be completely doom and gloom here. There are legitimate reasons why the market might be able to sustain these higher valuations. The Federal Reserve has been incredibly accommodative over the past decade, keeping interest rates low and pumping liquidity into the system. When interest rates are low, the discount rate used to value future earnings is also low, which can justify higher stock prices. Additionally, the rise of artificial intelligence and other technological innovations could lead to a step change in productivity and corporate profitability. If companies can produce more with less, then higher valuations might be warranted. The key question is whether these factors are enough to offset the historical patterns of mean reversion. Only time will tell, but as an informed investor, you need to be aware of both the bull case and the bear case and make your decisions accordingly. Now, let's talk about the Wild West of finance. The cryptocurrency market. If you thought the stock market was a roller coaster, you haven't seen anything yet. The crypto market has had a phenomenal run, with the total market capitalization soaring past the $3 trillion mark. Bitcoin is trading at around $90,000, and Ethereum is not far behind in terms of performance. The crypto enthusiasts will tell you that we are at the dawn of a new financial system, that these digital assets are the future of money, and that we're still in the early innings of a revolution. And they might be right. The technology behind cryptocurrencies, the blockchain, is truly revolutionary and has the potential to disrupt countless industries. We're also seeing a significant shift in the regulatory landscape. For years, the crypto market has been plagued by uncertainty, with governments and regulators unsure of how to handle this new asset class. But now we're starting to see some clarity. In the United States, Congress is working on legislation to create a clear regulatory framework for crypto. The SEC is providing pathways for the tokenization of securities, and the CFTC is gaining more authority to oversee the market. This is a huge step forward for the industry. It provides legitimacy, encourages institutional investment, and protects consumers. This is a narrative that is often framed negatively in the mainstream media, which tends to focus on the risks and the scams. But the reality is that a clear and sensible regulatory framework is a net positive for the long-term health of the crypto market. But, and there's always a but, we have to be realistic. The crypto market is still incredibly volatile and speculative. The truth is, nobody really knows what the fundamental value of Bitcoin or Ethereum is. Unlike a stock which represents a claim on a company's future earnings, cryptocurrencies don't generate any cash flow. Their value is based purely on what someone else is willing to pay for them. This makes them susceptible to massive bubbles and crashes. We saw it in 2017, we saw it in 2021, and we will undoubtedly see it again. The crypto market is driven by narrative and sentiment, and those can change in a heartbeat. While the long-term potential is undeniable, the short-term risks are just as real. It's a high-risk, high-reward game, and you need to be prepared for a wild ride. So while the crypto bulls are celebrating the recent surge, it's important to remember that this is a market that can turn on a dime. Don't invest more than you're willing to lose, and for goodness sake, do your own research. Don't just listen to the hype on social media. Let me share something else that the mainstream media doesn't often discuss. The crypto market has reached a $3 trillion market cap before. Back in November 2021, the total crypto market capitalization exceeded $3 trillion, and analysts at the time were comparing the exuberance to the dot-com bubble. And guess what happened next? The market crashed. Bitcoin fell from its all-time high of nearly $69,000 down to around $16,000 by late 2022. That's a decline of more than 75%. Ethereum and other altcoins suffered even steeper losses. So, when you hear people saying that crypto is going to the moon, remember that it's also been to the basement. The volatility is real, and it's not for the faint of heart. That said, the crypto market has shown remarkable resilience. It has bounced back from multiple crashes, and each time it has come back stronger. The infrastructure is improving, the regulatory environment is becoming clearer, and institutional adoption is growing. Major companies like Tesla, MicroStrategy, and even traditional financial institutions are now holding Bitcoin on their balance sheets. This is a far cry from the early days when crypto was dismissed as a fringe technology for criminals and speculators. So, while the risks are real, so is the potential. The key is to approach this market with your eyes wide open, understanding both the opportunities and the dangers. Finally, let's turn our attention to the old guard of the financial world, commodities. In a world obsessed with tech stocks and crypto, it's easy to forget about the raw materials that actually power our economy. But in times of uncertainty, commodities can be a safe haven. And right now, we're seeing some very interesting and divergent trends in this market. Let's start with gold. The yellow metal has been on a tear, soaring past $4,400 an ounce. This is its strongest performance since 1979. So, what's driving this? Well, it's a perfect storm of factors. We have rising inflation, a weakening dollar, and a whole lot of geopolitical uncertainty. In times like these, investors flock to gold as a store of value. But here's something you won't hear much about in the mainstream media. Central banks around the world are buying gold at a record pace. They're diversifying their reserves away from the US dollar, and they're hedging against the very same risks that are making individual investors nervous. This is a huge vote of confidence in gold and a powerful long-term tailwind for the price. JP Morgan is forecasting that gold could hit $5,000 an ounce by the end of 2026, with some analysts even calling for $6,000 in the longer term. So, while gold might seem boring compared to the high-flying tech stocks and cryptocurrencies, it's quietly having a moment in the sun. Now, let's talk about oil, and here the story is completely different. While gold is soaring, oil prices are under pressure. And the reason is simple: we have a massive supply glut. The world is awash in oil, and there's just not enough demand to soak it all up. The International Energy Agency estimates that oil production could exceed consumption by a staggering 3.8 million barrels a day in 2026. Goldman Sachs is predicting that oil prices will bottom out in the middle of the year. This is a story that is not getting a lot of attention in the mainstream media, which is still focused on the narrative of high gas prices and energy shortages. But the reality is that we are in a period of oversupply, and that is likely to keep a lid on oil prices for the foreseeable future. This is good news for consumers, as it means lower prices at the pump. But it's bad news for oil producers and investors in the energy sector. The same goes for natural gas, which has seen its price plummet in recent months due to a combination of high production and a mild winter. So the commodities market is a tale of two cities. We have gold, the safe haven asset, shining brightly in a world of uncertainty. And we have oil and natural gas, the industrial commodities, struggling under the weight of oversupply. What's particularly interesting about the commodities market right now is the divergence between different asset classes. Gold is benefiting from what I call the fear trade. When investors are worried about inflation, currency devaluation, or geopolitical instability, they buy gold. And right now, there's plenty to worry about. We have ongoing tensions in the Middle East, uncertainty about trade policies, and concerns about the sustainability of government debt levels in many developed countries. All of these factors are driving investors toward gold. On the other hand, oil and natural gas are being driven by the fundamentals of supply and demand. And right now, supply is winning. The United States has become the world's largest oil producer, and production continues to grow. At the same time, demand is not keeping pace. Economic growth in China, the world's largest energy consumer, has been sluggish. And the transition to renewable energy is starting to have an impact, albeit a small one so far. So, we have this interesting situation where gold is being driven by fear and sentiment, while oil is being driven by cold, hard supply and demand fundamentals. This divergence is a reminder that not all commodities move in the same direction and that each market has its own unique dynamics. So, where does that leave us? Are the markets overvalued? The answer, as you've probably gathered, is not a simple yes or no, it's complicated. The stock market is undeniably expensive by historical standards, and the risk of a correction is very real. But there are also powerful forces at play, like the AI revolution, that could continue to push prices higher. The crypto market is a land of incredible opportunity and stomach-churning risk. It has the potential to change the world, but it could also crash and burn. And the commodities market is a mixed bag, with gold offering a safe haven while oil and natural gas are struggling. What is clear is that we are living in a time of great uncertainty and rapid change. The old rules don't seem to apply anymore, and it's more important than ever to be a savvy and informed investor. Don't just follow the herd. Don't just listen to the talking heads on TV. Do your own research, understand the risks, and make your own decisions. That's the only way to navigate these treacherous waters and come out ahead in the long run. Let me leave you with a few practical takeaways. First, diversification is more important than ever. Don't put all your eggs in one basket. Spread your investments across different asset classes, geographies, and sectors. Second, be prepared for volatility. The markets are going to be bumpy, and you need to have the emotional fortitude to ride out the storms. Third, focus on the long term. Don't try to time the market. History has shown that trying to predict short-term movements is a fool's errand. Instead, invest in quality assets and hold them for the long haul. Fourth, stay informed. The world is changing rapidly, and you need to keep up with the latest developments. Read widely, listen to different perspectives, and always question the conventional wisdom. And finally, don't be afraid to seek professional advice. If you're not confident in your ability to manage your own investments, there's no shame in hiring a financial advisor. Just make sure you find someone who is trustworthy and has your best interests at heart. I hope you found this analysis helpful. If you did, please give this video a thumbs up and subscribe to the channel if you haven't already. And I'd love to hear your thoughts in the comments below. Do you think the markets are overvalued? What are you investing in right now? Let's have a conversation. Thanks for watching, and I'll see you in the next episode of Boni's Life.